Hi, my name is Arthur Halleran. I'm CEO of Trillion Energy. We're an oil and gas producing company in Turkey, with predominantly our major asset is in the offshore in the Black Sea off Turkey.
Great. Art, nice to meet you. Thank you for the introduction. Now, the last time you spoke with Crux was in September of last year, and you had just raised some money, and you were going to use that money for a drill program. Can you just remind me how much you raised, and what was the drill plan that you laid out in September?
Yes, we raised a total of $41 million Canadian, and we spudded our first well in October of last year, and we're drilling long-reach directionally drilled wells off of the platform to access the proven gas pools. And we've drilled now 3 of these long-reach directionally drilled wells. One of them is measured distance of 4 kilometers, and we've also recompleted another well. So now we have 4 producing gas wells. So that's 4 for 4, and we are pretty well halfway through our fifth well, which will be another gas well because we're twinning a discovery that was not put on production. We start off with about $31 US an MCF gas, and we're still in the $15 US MCF range. And then each well will test between 6 to 10 million cubic feet per day. They're capable of being put on production 3 to 4 million cubic feet per day. But right now they're being choked a bit back because when we put on a higher pressure well, it backs out some of the production. So we are in the process of just drilling gas wells and putting them on production.
Are these wells in production already? The 3 long reach wells that you've drilled and the recompleted well, are they on production already, or are they still yet to be tied in and cash flow positive?
Yeah, so that's a very good point, because I always forget to bring that up, is that we have the existing infrastructure. It is already there. So we have 4 platforms, 18 kilometers of subsea pipelines, and an onshore production facility. So when we drill these wells, we perforate them and we turn them over to the production department, which is TPAO, our 51% partner, which is the Turkish government, and it's on production within 1 day. So there is no time delay or any extra capex to bring these wells on. And the other thing is, because there's a push with TPAO not to be more environmentally friendly, all the testing and everything we do on these wells are within our facility, so not one molecule goes to the atmosphere.
So that means that that's fantastic, and that means that when you do the testing, does that generate cash flow, or is that just like, does that flow into is that metered?
Yeah, that's correct. So it's tested into our pipelines and through a meter and right into our facility, and you can imagine that you can contain some of the gas in your facility and your pipeline. Yeah, you just build up the pressure, but we have a good, the sales pipeline is right at the edge of the facility, and because TPAO is a government company, they make room in the sales line, so the wells are drilled between 45 to 48 days, and then are right on production. And the whole intent here is we already have 4, and then we're going to have 5, and we plan to exit 2023 with 13 wells. So when we get towards the winter, we are actually going to have a lot of gas wells producing to capture any increase in the price of gas.
Now, clearly a 4-kilometer long-reach directional drill hole well will cost more than one which is just kind of a short vertical, but what is the range of these costs of each of these wells that you're drilling?
So the range for their long reach directional drill wells are between $11 to $13 million, and so far we've been on budget and on time. And right now we're pushing the envelope. In other words, this is some of the really new technologies that has not been done in Turkey and a lot of part of Europe, because these are quite because of the stratigraphic interval is quite not that thick. We're only drilling true vertical depth between 14 to 1,600 meters. And so the measured depth is up to 4 kilometers. So there's a lot of engineering issues. And what I've always said in any of my presentations is, we know the gas is there. There's no mystery about the gas. There's a lot of gas because we went from 20 BCF to 48 BCF and then 63, and that's just our 49%. And we're finding more gas. It was always an engineering exercise on being able to do enough upfront loading and learning to drill these wells.
When I listened to the interview that you did in last September, you talk about it being the kind of the last money that you'd ever need to raise. It was $41 million US, Canadian, $30 million US, and you were going to drill the wells and you're going to be cash flow positive. And you've just raised a debenture of $15 million.
That's correct.
Does that mean that it's cost more than you expected to execute that engineering phase?
Part of that answer of that is, yes, things slowly creeped up in cost, but that wasn't the reason why we did the debenture raise. The reason why we did that was there's a couple of really good, solid reasons. One of them is we now have added 6 more wells in between. We've always had 7 and then 10, and now we put in another 6 in between. And these are not directionally drilled wells. Well, they're not long reach. They're still directionally drilled wells. They are sidetracks from existing boreholes. And what we found was when we recompleted Akachoka 3 and the G&G started taking a look through the data, the old 4 pools were never totally drained. So they would look at it and they would say, okay, the pool had 14 BCF and they only drained 9 or 5. And they looked at it and they see it potentially because they didn't use big enough perf guns, or they perforated 4 or 5 zones and one watered in. So we're just doing directionally drilling out of the existing old borehole instead of going in and trying to cement off the old perfs and so on, and then going out a bit and then drilling into new, like a new zone, but still in the old pool. And this is a long answer. So we had to buy some like whipstocks and so on that were not in our budget. So this debenture is partly used for that. The other thing is our shares have always been, they just seem to be stagnated in the 37, 38, 40 cent range. And I don't think that the message is getting across that this is it's a boring story. We just drill gas wells, we bring it on, and there's just not a lot of excitement about it. So I want to kickstart the exploration, because the exploration will be a jump start. It's like a different magnitude of target. And for that, I need a couple extra $1 million. And finally, the other reason for the debenture, and there was a lot of chatter that we didn't have enough money. And there was a lot of chatter out there that a group said that they could do a pure equity raise in the low 30 cent price range. This is Canadian. And what would happen is we'd go on the road show, we'd talk to good investment funds, but they would not buy in the open market because they say we're going to wait for the equity raise. And the equity raise was never going to happen. It was just a chatter. So we thought if we did the debenture and the convert, if they do a converts at 60 cents, that people would now look at it and say, okay, they have enough money. And if they are going to convert, it'll be at 60 cents to try to get rid of that discussion or perception that why should I buy in the open market if there's going to be a low price equity raise anyway. So that was the reason for the debenture. And finally, as a CEO, a little extra money gives you opportunities for other things.
How are the first 3 or 4 wells performing? Are they giving you the netbacks that you worked on? I see that in your presentation you talk about at a price of $17 per MCF, you get a netback of $13. Do I just subtract $2 when the average price is $15?
That's correct, yeah. And the thing about the wells, So we purchased the existing infrastructure. So you will have the 3 platforms are on small spurs into a main line. And I'm just trying to give you a discussion on the performance of the wells here. So the wells, in a well, we might find 75 meters or 35 meters of pay, and we're not completing them like they did before. We're not trying to perforate 8 or 9 zones. We're starting off at the lowest zone, and if we get a certain production rate, we put that on, and then we're going to produce that until you get a certain decline, and then work up hole and perforate it, because the platforms have a wire line, so we don't need the rig to put that on production. But what's happened is we have reservoirs at 1,400, 1,200 meters, and we have reservoirs at 1,600 meters, and it was like 3 straws attached to a bigger straw. So like Gulich was at 2,000 psi, and West Akachoka was producing at about 1,400 psi. So when we put on Gulich at 6 million cubic feet per day, it backs out some of the other production from the other wells. Like the other well was producing 3 million, and it might back it out. That only affects it in the short term, and people seem to be more concerned about the short term due to the price. But over the life of the field, none of that gas is lost. It'll all be produced. So the wells are actually still performing very well. Like Akachoka 3, which was a recompletion, and it was like about 5 meters of sand, produced about $8 million of gas already. It only costs us about $3 million to do that.
Okay, gotcha. So when did that come on stream, that one, Achoka?
Akachoka 3 would be November, towards the end of November. It was our second well. And that was when we learned that we better not be fishing for things in the borehole, because we were about $2 million over budget on that one, and that's the only one we've really been over. And because fishing jobs, when you have junk in the hole and you try to catch it and pull it out, can sometimes be a real bear. And so that's when we decided, that, and it can sometimes just run away. So you have a job that's going to say you're going to cost $2 million. You can end up spending $6-7 million. And then the sidetracks don't cost $13-11 million. They're like $7 to $9 million, and that's why we're doing those 6 sidetracks.
Thank you. I'm just trying to work out because a lot of the investment case in Trillion is the cash flow story. The fact that by the end of the year, according to your presentation, you're looking at $70 or $75 million run rate. But the tricky point is navigating there. So it's looking to see how the cash balances, the cash in balances the cost out over the next 3 months. I would say is kind of crucial.
Yeah, that's right. And the one thing about this project is, if it was just 2 or 3 wells, you would get squeezed. So when we had a good high price, we were, making a lot per month. Now we're at about $15. So you say, okay, we're making about $1 million a well per month, right? And so you say, okay, I'm going to exit the year with 13. So that's $13 million a month. So you're now talking, 130, about $140 million a year. So you can now say, okay, well, what if I just get half that, right? So you can see that even at $750,000 per well, 10 wells, you're making $7.5 million a month, right? And that's the whole key. So we already going to be, the next 2 wells are, if they fail engineering, that's the only way they won't work, but we have well insurance. So we already have 4. 2 more are for sure. There's no way they're not gas wells, because they were vertically drilled, tested. I can tell you that the well we're drilling right now, Behanli 2, the well has got about 35 meters of pay. I can tell you it's going to test about 6 to 10 million cubic feet per day, because that's exactly what it did before, right? So the cash flow, when we were getting $31 or $17, you could say, okay, I got 4 wells, I'm safe. Now I look at it and say, okay, I already got 4. I'm going to get 2 more. So if I get 7 wells, then things are pretty well paying for
when you
itself
say
and so on.
so 4 plus 2 to get to 7, does that mean that you're there's another one in the well that's half drilled at the moment?
That's correct. So that includes that one. So we already got 4 wells, and the handling now is about a couple of 100 meters from intermediate casing, which then is about another 100 meters from TD.
Okay.
Right. And
then 2 more after that.
And then the other one is Alapili, which would be right after that. So those are the 6-2, the 2 existing existing gas pools. And then we're going to have 6 more sidetracks, because we just find them, they're just very low risk. They're cheaper. We're trying to accelerate. So instead of taking 45 to 48 days, it only takes about 31 to 35 days to drill, complete, and put on production. And in that way, instead of bringing another rig to drill more wells, which is a whole exercise on itself, we'll try to be like an accordion and fit more wells by drilling wells that are faster and cheaper, but still with the same gas punch, like the same rate.
And so will all of those 12 wells be targeting the 63 BCF resource or the reservoir?
At the end of the year, we didn't have Gulich, right? And we didn't have West Akachoka. And so that was your 40, 45. And then when we had Gulich, which added, almost like 12, we went up. That's just our percentage. Like I always say, we went up to about 63 BCF. And so you have additional wells that are attached to that to actually capture that gas. How many, we don't know, so we have to wait for the pressure analysis and so on. But what people don't really know is that Gulich, South Akachoka, and West Akachoka were actually exploration wells.
Okay,
right. They were never reserve wells under the definition of the 51101 from the GLJ report. But when we looked at them, we saw that they were the same seismic signature, all that kind of same stratigraphic. And because we de-risked the model, the reserve engineer actually, at the end of the year, no longer had West Akachoka as an exploration. They had it as an extension because they realized that we've de-risked the model. So the 63 BCF is just for the reserve wells and these discoveries that we've done. They don't include the other prospects from the GLJ report. And they also do not include any of the stratigraphic exploration targets that we're refining. So what we've done, we had the 3D seismic, which was very good quality, but the processing wasn't really done that well, and it was also depth processed. Time processed, whereas now we got new algorithms. We're going to depth process it and redo the AVO. And when we took a look at it and had an early look to see the parameters for the future, so we've already started it. It'll be finished in September. So it's an existing data set. We find that there are, like I say, there's way more gas than even I anticipated. We find very large stratigraphic type targets that are in exactly the same reservoir, have exactly the same source rocks, and the same seismic signatures and AVO anomaly as the structural targets that we have. So from my experience, they'll be gas bearing. It's just that nobody's ever drilled one, and therefore you can't even, there would be classified as a grassroots exploration. So after we get all the seismic and so on, I will send that over to the engineering firm to get some kind of resource number. But we're going to try to probably drill the best one in 2024. And if you look at it, I would say there's probably 100 plus BCF for the stratigraphic. So that would be added to the other reserves. So and just so you could, so that 63 BCF is actually like 126 BCF for the whole lease, right? The 63 is just our 49%. Yeah.
Okay. And the other prospects which are outside of that 63, were outside of the JLG report, These are you've got a whole suite of structural targets as well as the stratigraphic ones that you've just been talking about.
Yeah, so we'll start with, we have the reserve structural targets, and we have a report on that. Then we have the structural resource targets, which we have a GLJ report on that also, because it's the same animal as the ones that are the reserves. So it might be a limb that's sticking out or a similar structure but has not been drilled. So we have those. But then there's another whole layer that is strictly stratigraphic. So you have your structural component, and then you'll have onlapping or something on that structure, or you will have a channel that's in a low area. Those have not been evaluated with the third party yet, but those are the ones that we're getting the data reprocessed and so on. And I would, like I say, suspect you're going to have more gas in those stratigraphic targets than in all the structural ones that we've already drilled and are going to drill.
Are these well-established stratigraphic traps in the region? Have other people drilled them?
No.
And no.
So again, we're the only guys in the area, so there's no competitors. And the reason why we just say that they have a high probability is because, if you can imagine, they're exactly the same stratigraphic layer. They're buried in the same source rock. They have exactly the same seismic anomaly that says it's gas saturated, but instead of being curved like this, it's just a flat line body. So there's no reason to suspect it's not gas. Like, it's exactly the same character, it's just that it doesn't have a structure. So it just said it's never been drilled before as a strictly 100% stratigraphic target. So nobody's drilled them yet. And, by the end of 2024, we'll probably put in the best candidate, end of 2023, beginning of 2024, and then drill that. And if that's successful, then that de-risks the whole stratigraphic exploration. Yeah.
The whole play. Tell me a bit more about the AVOs, these amplitude variability offsets, because in my understanding, which is fledgling, it works better in younger, less well consolidated geology, and it can give up false anomalies, kind of fizzy water, just kind of saturated, a little bit of gas and water. So can you just talk to me a little bit about your confidence in using AVO as a targeting vector?
Yep. So these sands or clastic sandstones, they're conventional reservoir. They are unconsolidated or slightly consolidated, so they're very, like you say, loose, really good porosity, 28%, fantastic permeability. They are the Eocene, Miocene type sands, and they are stacked from the past. So what's happened is that before, it was what it was like a pseudo AVO. And what I mean by that is they saw a characteristic in the seismic, and it turned out that when they drilled it, they got gas. When they didn't have one and they drilled it, they got no gas, right? And that's why they had an 80% success rate. But what I had my geophysicist do is to go back to the data and actually do a real AVO with the old data and calculate the AVO. And that's why we came up with all these really nice stratigraphic traps. As you can see, there's the AVO in it. And so we have that. We gave those parameters to the seismic processor, and that's going to be redone. Like, it's going to be finished in September, but we're going to spend a couple of months. So we are very confident we can identify gas, but you bring a good point, and this is where, if you want to justify another platform or so on, so you see 4 or 5 nice targets that you can reach from a platform, but you want to be able to define whether at the edge of the anomaly it's a 40% gas saturation or 60% gas saturation, because that makes a big difference in the economics, and also will make a difference in the size of the gas pool, right? And so that's what we're trying to resolve. So right now, what they've done is they've drilled the ones that they basically say, yeah, we know it's 80 or 70% or 60% gas saturation, and we're trying to now just feather that out and maybe define 40 or 50% type saturation. At the same time, with the depth structure, the depth, seismic correlation, we're going to get a better structural map. So we might find like little limbs sticking out from the old structural prospects. So it's pretty exciting. And the reason why it's really exciting is that we started with 20 BCF reserves, then it went to 48, then 63. And that's, like I say, that's just half. That's our half. But when we look at the stratigraphic, we see that we're going to double it.
Right. So the sandstone reservoirs, you're sufficient. They've got you're satisfied they've got sufficiently good cap rocks to provide stratigraphic traps. There's a permeability barrier above these sands that gives you the confidence that the sandstones are potentially gas filled.
Yeah, that's correct. Because what it is, it's some of it's turbidite flows, but a lot of it is the sand that's flowing offshore down canyons and then went out in platforms, and then it would sit there nice and quietly for a while, and then the mud would settle on it, and so you have the sand shale, and that's why we can get 75 meters of gas sands, but there might be 8 different sands or 9 different sands, because each little shale, and then in the deeper structures, it's not that deep, it's like 1,200 meters and so on. Even when you get the folding, you don't get the flower structures. Like, when you get the apex, you get fine little breaks, and then the gas will leak out. It's nice rollover in the front. But as you start getting more shallow, closer to shore, the structures have bled. So you have a whole bunch of little fractures in the apex of the structure, but not where we actually are producing.
And on-lapping the stratigraphic target can be respectable volumes. I know that it's got a channel dimension to it, but it can still be a decent volume size.
Yeah, so that's it. That's exactly it. So, but potentially these some of these stratigraphic targets are not going to. So the structural ones are broken. You have an east limb, a left limb, and a main structure, and so you have 3 separate little pools. But for the on-lapping or some of these channels, they aren't broken up, and so you're going to find a larger pool which you can drain with less wells, and then also off-block. So we have the block, and then off-block there's some very larger structures. So the structures on SASV are like 3 kilometers by 1 kilometer. The other ones are like 5 kilometers by 10 kilometers, and on that you start looking, see if you can see any on-lapping, and we have all that data. So the really exciting thing about it is that because we have the existing infrastructure, we have the competitive advantage, because with all the gas, without the stratigraphic ones, but with the structural ones, if you didn't have the existing infrastructure, you probably would not even pursue a lot of them, right? Because it would be pretty capex intense.
When you talk about off-block, what do you mean by that? The bigger targets you're looking at.
So what we do is we have the production lease, which is called SCSB, but at one time we owned all the land, like, probably 20 times the amount of land. And so we have all the seismic, we have many prospects mapped and so on. And that's what I call off-block. The conversation at around 2000 was, they know these structures are there, they know their potential filling and so on. The conversation was there was not enough gas generated in the Black Sea, in this area, to actually charge the larger structures. So they made a conscious decision to drill the SASB types. Well, now with the big discoveries by TPAO, which is our partner, the Turkish government, they have found 19 TCF about 100 miles north of where we are, roughly within the same stratigraphic interval and the same source rocks. But what it really says is that the evolution of the basin was such that there was a lot of gas generated. So these larger structures or larger stratigraphic traps, there was enough gas to charge them, full.
And Is there competition in your? I mean, I know you said that you don't have any immediate neighbours, but surely with the success, the recent exploration success in the Black Sea, there are other people looking at your. I mean, is the data that you've got on your off-block area, is that widely available? Are other people looking at it? Do you worry about potentially the better targets being scooped up by someone else?
Yeah, so most of the discoveries are where TPAO is at the edge, and so it's in the waters where all the land meets with Bulgaria and Romania and so on. So there's a lot of discoveries there. Where we are, there's an area from the shore to a certain distance out where we can pick up the land 100%, but past that, it all belongs to TPAO, the Turkish Petroleum Company, and you would have to farm in for that. As for competitors in the area, there are none, and you know how it works. I'll say, okay, I'm going to look for a 200 BCF target or a 500. You always end up finding more smaller ones than larger ones, so I might find a 50 or a 20 or a 30. Any competitor, anybody, they can't put those on production because they aren't big enough to build build a facility or all that kind of stuff. Whereas with us, we could do subsea completions and run a spur to our closest platform, and then run it through our, gathering system down into our facility. So that's again how we can do it. A lot of the seismic only we have; nobody else has that seismic, and of course we have tons of prospects in our files because of that.
It's always nice to talk about the big exploration prize. It's always good to talk about the structures which are 5 kilometers across or whatever it is. But while that is always out there as a kind of a degree of optionality or exploration upside, it feels as if the kind of the bread and butter of the company is incremental addition of new wells, new sidetracks, build up that cash flow. Build up that cash flow until you become a compelling investment on a cash flow basis, and just kind of backed by your resources and reserves. But are you looking to drive the value of your company as a multiple of your cash flow? Let's say you're able to demonstrate that you can produce a run rate of $100 million a year, or $50 million a year, or $200 million a year. Are you then looking to compare yourself to your peers and say, listen, they trade at 10 times or 7 times earnings. We should be trading therefore at $700 million or $1 billion. Is that the kind of investment thesis?
When I first started, I looked at SCSB, and I always like a project like this because existing infrastructure is the most important aspect of it, and you have to have, of course, potential reserves. And I always thought SCSB is a company maker. SCSB, I always thought, $1.50, $2 a share, because the gas is there. It's just drill the wells, put them on production. And I thought we'd be, 60 cents, $1.50, $2, generate a lot of cash flow. But it was always to be the cash engine to do like a bigger project with more impact, because imagination is always bigger than what reality is, right? And we're not getting the value for SCSB, but you can imagine if we're going to be generating, say, free cash flow of $40 million a year or $50 million a year or $7 million a year, and we're not talking 6 months, a year, 2 years, and its cash is gone. These wells have got 75 meters of pay in it. To drill the well costs, say $11 million. To recomplete with the wireline costs $300,000. So right now the wells are producing out of a 5 meter or 7 meter zone. So then we're going to produce that, generate a lot of cash flow, and then for another $300,000 to $500,000, we perforate another zone. And so we're going to be generating a lot of cash. So either we pay income tax or we use it to find something bigger, right? And there are a lot of opportunities in Turkey, and I always say off block, and that's really grassroots exploration. So that's one thing I have to, say is that maybe we're looking at the Cretaceous, there might be something there, or we look at the same stratigraphic interval, but it's grassroots. It's, we're looking for a big project, but, the risk and reward. But there's also a lot of opportunities in Turkey and other places around that I think with the same kind of attention to detail and bringing more advanced technologies, I think there's a lot of potential for a bigger project. So SASB, 200-300 BCF, but I think there's projects out there, half a TCF and a TCF.
Yeah, exactly. Go for the swing the bat and go for the TCF. In a sense, the credibility on the SSAB is going to come with the quarterly, with your quarterly cash figures, at the end of each quarter. I think that's going to be the yardstick, and it might take another quarter or two for the market to catch up. But when it does, I think that's when you would look to get the re-rating. So I think it's all going to be about cost management, and then it brings me to the other side of the equation, which of course is the gas price, because your revenues do depend on gas price. We've gone from 31 to 15 in 8 months. It was a super crazy time last year. I noticed that yesterday some of the energy costs in Europe were up at $10,000 per kilowatt hour on a short time basis, because of the irregular supply, the lumpy supply. Have you got a view on where gas prices are going during the course of this year?
Yeah, so I'll step back a bit. So when we went through the project, we were always happy at $8 to $9 an MCF, because that's been the historic price in Turkey. It's always been like that, I think, for the last 10 years. Before all this invasion and so on, it averaged like $8 to $9 an MCF. So we did all our calculations at $8 to $9 an MCF. We started our first raise. We got a price reservation from the security exchange, and then the invasion happened while we were doing our raise. And of course, we got oversubscribed, and we didn't take it all because we didn't want to be really diluted at that at that low price. But now when you look at the price, we're still getting $15, just under $15 an MCF. And I don't think it'll go down below 12 over the summer, and then it's going to ramp up back into the winter, because the supply is just not there. Like, everybody's talking about LNG, how that's going to make the difference. But Europe, I don't know how true it is. I'm just reading it. They've more or less swiped the LNG from the Asian countries by outbidding them, right? And so that market is still there. Yeah. So I think there's going to be some arm wrestling, and the price is going to go up, and it doesn't have to go to $30 for us. If it goes up to $20, $26, $18, that really makes a big punch for us, because we don't spend any money on infrastructure capex. It's only drilling. And so I'm really hoping that, well, it's not going to be a hope, because this well will have probably it'll be 4, maybe 7, 8 wells, maybe a bit more by early, late summer, early fall. And that's when the price should start ramping back up again.
Thank you very much. I've got a much better understanding of the company now than I did before. It's good to learn about the geology and the infrastructure advantage that you've got, and the way that your wells are being structured in terms of the rollout. The rollout of your news flow. Kind of what do you how do you envisage kind of delivering news to the market? Are you going to do it in quarterlies, or are you going to do it on a more ad hoc basis, and what are the key milestones that you'll be looking for?
Yes. So when we first started this, we had a story that we were going to do this and we're going to do that. And the one thing that people don't realize is that this field was mothballed. It was pretty well slated for decommission, and it's because they weren't comfortable drilling out a certain distance. It was past the envelope. So we walked up and we said, we're going to drill these wells for this cost, and we're going to access this gas. And the conversations that we had were, well, there isn't enough gas there to do that. You can't drill the wells because it's technically impossible, and you can't do it for that price. So we've done everything we have said we're going to do. And right now, so all we're really going to be doing is exactly the same thing, which that's my one comment, is that it's a boring story. There is no really risk and excitement. It is putting a well on every 45 to 48 days and putting it on production within 1 day after perforating it, and exiting 2023 with about 11, 12, maybe 13 wells producing. The only maybe big news that might happen would be, I will say, I have picked up a exploration block with this kind of a potential, and more of a larger type target. So that's the one conversation when we talk to bankers. They like it. They don't like anything that's rocks a boat and that's mystery, and we say the gas is there. I'm hoping to have an exploration well, one of the stratigraphics, maybe early 2024. But this conversation, when you talk to investors, they start yawning. They start saying, well, because they don't realize that we could lose a well and it won't make a difference to the project, right? We have 13 wells for this one. We could drill. We basically have all the wells organized for all of 2023, early 2024. And then we're going to add some exploration stratigraphic wells. And so we went on road shows and we talked to people. So I'm just hoping that eventually we'll get some big firms that will say, yeah, they're just treading through the snow, getting to the place. And each time there's a well on and they're doing exactly what they say. And then we can just take the pencil and work out the cash flow. And so when we start getting to like the 6 or 7 well, and we start having the big cash flows, even at the lower gas price, I think people will start believing the story, even though they should, because we've already done 4, right?
Art, thank you very much. I look forward to seeing the progress through the course of the year.
Okay, thanks a lot for the chat. I really appreciate it.